This is probably the best strategy for getting started with real estate investing, and it's actually how I got started some years ago. One of the best parts of this strategy is that it requires very little money compared to other types of real estate investing strategies, so it's definitely worth considering, especially if you're just starting out. But before I get into that, just want to introduce myself for anyone who is new to the channel. My name is Jack Duffley, and I'm a 24-year-old real estate investor and attorney, and on this channel I cover a variety of topics as they relate to investing and personal finance, so if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. Now, if you haven't already guessed, the strategy here we're going to be talking about is house hacking. The fundamentals of house hacking are very simple. You buy a place and you move into it, but you buy a place that has extra space, whether that be extra units or extra bedrooms. You rent out that extra space, and that rent offsets your living costs. In the best of house hacks, you can basically live in the property for free because your tenants are paying for your expenses and the mortgage, so you don't actually have to come out of pocket on those things. And if you don't want to live in that place anymore, you can move out and keep it as a rental, so it's not as though you have to live in it permanently, which is another huge advantage. Now, I've gone over the exact numbers of how my house hack worked here in Chicago. I bought a 2-bed, 2-bath condo, and my wife and I rented out the extra 1-bed and 1-bathroom effectively, and that basically offset our entire mortgage. So we had very subsidized housing, yet we got to keep all the equity and all that extra upside that you get with holding real estate for the long term. And I've already done a detailed numbers breakdown on that house hack, so I'll include a link to it in the description below if you want to check that out. But the big reason I want to talk about house hacking, especially right now in a very hot market across the US, is the fact that it doesn't require nearly as much capital, nearly as much money to actually get started with. Because with quote-unquote normal real estate investing, where you just buy a rental straight up, you're not living in it, and if you're going to put a loan on that, typically you're going to have to bring at least 20% as a down payment to the deal. And that's before you get into expenses, bringing any reserves to start with, or any rehab costs, so it can get pretty expensive, especially in more expensive markets. And on top of that, the interest rate isn't always going to be the best compared to what you can do as an owner-occupant, and that's where the big advantage of house hacking comes in. Because you're living in the property, you can take advantage of owner-occupied financing, where you're agreeing to live in the property for at least some amount of time, since the whole deal is that the government is subsidizing these mortgages for people who intend on living in it. But you don't lose that financing after you eventually move out if you so desire. So the interest rate is typically a couple percentage points lower than if you were just buying a straight-up rental. Usually, you can find exceptions where you can get really great financing on even straight-up rentals, but typically the best financing terms you could possibly find are 30-year fixed-rate mortgages for owner-occupants. And that's just the interest rate advantage. Wait until we talk about the down payment advantage, because with a rental property, like I was saying, you're typically going to have to bring at least 20%, sometimes more, to the table in actually to acquire the property. So your down payment is going to be pretty substantial, even if it's a fairly cheap property. Whereas with owner-occupied loans, you typically only have to bring a few percentage points down, if any at all. With something like a VA loan, if you're a veteran, you can usually get into a property with 0% down. That's right, you don't even have to bring money to the table to acquire the property. The bank will finance the entire thing. But it's not like non-veterans are getting some raw deal here, since you can use an FHA loan, which only requires 3.5% down. However, there are some loan limits on FHA loans. With a conventional loan through Fannie Mae or Freddie Mac, you can put as little as 5% down for most properties between 1 to 4 units. Though as I've learned, especially after the pandemic has happened, the more units there are, typically the more you're still going to have to bring down, even with these great loan programs, but you're still going to take advantage of those awesome interest rates. But at least as it stands now, even for a 4-unit property, the most you'd have to bring down for a conventional loan would be a 20% down payment. So it wouldn't be any worse than a rental, and you'd get a better interest rate. But for a single family unit, typically it's no problem to get a 5% down mortgage. Obviously talk with a loan officer, since this isn't financial advice by any means, and your credit will definitely determine what actually goes into your loan terms and how it actually is going to work for you. But do realize that these options exist, and you can get some pretty amazing financing terms. For my condo that I bought in Chicago, that was with 7% down. I wanted to put a little bit more in to lower the payment just a tad to make sure that it would cash flow no problem if I ended up moving out. So that was 7% down at something like, it was about 4.5% interest at the first time that I got it, since this was before the rate cuts, which is really more like 2.25% now because I have a HELOC on it, but that's a different story. So really low interest rate, fixed for 30 years, and all I had to do was bring 7% down. And I could have brought 5% down or even 3.5% down if I did an FHA loan. I did conventional just because there's slightly lower fees and the interest rate is a tad lower, though it kind of depends on each loan program. They have some nuances, but it's almost always going to be lower than if you're doing a straight up rental loan. And by bringing such a small amount to the table at the beginning, that actually insulates you from a lot of problems in the long term if we get huge rate hikes hikes that would cut the value of properties by a significant amount, because you're only bringing, let's say on a $100,000 property, to keep it really simple, with that property, if you're doing 5% down, that's a $5,000 investment. That's your down payment. But then if you hold it for 30 years and the value halves, so the real estate market just doesn't go anywhere, rate hikes are through the roof by the time you actually are retiring 30 years from now, so that property is only worth $50,000 now. Well, you still 10x'd your money. You only put $5,000 into it. So as long as the rental income that was coming in could still meet the mortgage payment, since it's a fixed payment, remember, because it's 30-year fixed, you don't have to worry about anything else. As long as you're making those payments and paying down the loan, you have a paid off property, and all you did at the very beginning was put $5,000 into it, plus fees or whatever it is, just keeping this example simple. And the math will look very similar with a bigger property, assuming you can maintain all those loan payments through that entire time, ideally with rental income if you move out, or through your job or whatever's going on to actually make the payments. And again, that's if the property value halves from the day you bought it 30 years later, which I would say is pretty unlikely just given the amount of inflation we see through history. The government actively looks for price appreciation over the long term, so you'd think it would at least be stagnant or flat, if not at least more expensive, because there's just more dollars floating around. Though we'll see where we are. No one knows what the future actually holds. But let's say that it does stay flat. You buy it for $100,000 on day one using a $5,000 down payment, and then 30 years later it is still worth $100,000. Well, that would mean you have a paid off $100,000 property after an initial investment of only $5,000. That is a 20x return. And again, that's if it stays flat for 30 years. You don't see any price appreciation on the property. You're still getting a 20x return. And don't even get me started on a VA loan where you'd be bringing as little as 0% to the table, to where you'd actually be getting an infinite return based on the equity you're getting in the property. Now, I have to say that with any amount of debt, you're adding risk to any sort of investment, because the debt does not go away even if your rental income does. You're going to have to find a way to make those payments. That's why bringing reserves is a very good idea in any real estate deal, whether it be a house hack or otherwise. Have those reserves ready to go so that if something happens to the property, you can still meet those expenses. You can still meet taxes, insurance, any debt payments that you have. That's very important, and it's going to be what insulates you from a lot of risks in real estate, or really just any investing with debt. But if you do use that leverage responsibly, it can be a fantastic way to leverage yourself into real estate, increase your returns long term, and actually get into the game if you haven't started yet. Because with house hacking, you can get in with as little as 5%, 3.5%, or 0% down depending on your status. And you don't have to spend so much time saving up a massive down payment, even if you're in a more expensive area. Of course, you want to make sure the deal makes sense, and that's the hardest part to actually get through, is finding a great deal. But with something like house hacking, it can create an otherwise so-so or bad deal into a good one if you can use some creativity and you're taking advantage of a house hacking arrangement. Maybe you're paying a pretty high rent payment right now, but if you can find a way to control a piece of real estate and then rent out some of that extra space while you live in some of it, that could offset a lot of your effective living costs, even if it isn't that great of a deal. A so-so house hack could be a lot better than just renting in an expensive market. It's definitely worth looking into, even if it might seem like it's very daunting or challenging. There are ways to be very creative with something like house hacking. Like I said, if you want to see the numbers on my house hack and how it actually is significantly better than renting in the same area, definitely check that out in the description below, where I go through all the numbers in a real world example, my own house hack, my very first deal, which allowed me to save quite a bit of money to where I could buy my second rental property just a year and a half later. But anyways, that's all I've got for today. So if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about real estate, investing, and personal finance, then definitely subscribe, since I put out new videos every single week and wouldn't want you guys to miss out. But until next time, take care.